Get ready for a major shift. The US stock market and your chance to climb the ladder, it's all on the line. So, are you feeling uneasy about the current financial markets? You've probably heard, that the US stock market is headed for a major crash, and that this could be a golden opportunity to buy the dip. Some people are even warning that missing this chance could mean losing your shot at moving up the social ladder over the next 10 years. But is that really true? Recently, while many folks anticipated a US economic recession and a stock market plunge, the Federal Reserve actually warned of rising inflation instead of cutting interest rates. This means, higher business costs and living expenses in the US, even as GDP is declining. It's honestly a puzzling economic paradox. Earning money keeps getting harder, while prices just keep climbing. Despite all these negative forecasts, the US stock market unexpectedly surged right at the opening. This kind of suggests there's a large influx of money, with investors buying shares regardless of the price. So, why is this happening? While only a few people seem to pay attention to the global situation, stock markets in Indonesia and Turkey have already collapsed. This really indicates that the traps set by American capitalists years ago are now detonating. Historically, when the Fed raised interest rates, American capitalists would accumulate assets from Japan, South Korea, and Europe. Now, as these markets are gradually recovering, it signals that the bottom fishing phase is complete. Assets that previously saw strong growth might soon collapse, while those at their lows are actually poised for a boom. The biggest profitable investment trend for 2025 is, gradually revealing itself. In investing, making money isn't just about the timing of a buy or sell. It's a meticulous process of calculation, strategy, and thorough preparation. Like a race or a battle, victory doesn't come from a few seconds or minutes of explosive action, but from comprehensive foresight and readiness. True entrepreneurs and investors always win first, then fight, meaning they only enter the game when they're confident of victory. They even aim to make money without spending a dime, with others proactively bringing them funds. Conversely, if they foresee no win, they immediately withdraw. If you don't realize that the capitalist's plan has entered its harvesting phase, you might incur losses investing in United States stocks, shorting, or buying United States bonds. What needed to collapse globally has indeed collapsed. American capitalists have largely finished buying the assets they intended to acquire. The shearing the sheep phase is over, and now, the next stage is to help the flock grow their wool back quickly. So, what was the Fed's and the capitalists' purpose in raising interest rates? Imagine you have 100 million euros in Europe with a 1% annual interest rate. When the Fed raises interest rates to 5%, you'd probably want to convert your euros to US dollars and deposit them in a US bank, earning 5 times the profit. This move strengthens the US dollar while at the same time other currencies depreciate. As global money floods into the US, American capitalists use these appreciated dollars to buy depreciated assets and currencies all around the world. Last year, many companies in Asia and Europe were acquired by US capitalists. No matter how hard people in Asia or Europe worked, the money, in the end, eventually flowed into the pockets of these American capitalists. Even countries without many large businesses to acquire can become, prey through natural resources. Turkey, which is rich in oil and gas, had to mortgage critical national assets to US financiers when it couldn't repay its debts. Similarly, Indonesia, with the world's largest nickel reserves, saw its nickel mines acquired by US capitalists as the rupiah depreciated. So why do American capitalists have so much money to acquire global assets? Last year, the US stock market soared. As the global economy weakened and war erupted in Europe, global capital really had nowhere to go but the US, the most stable economy. The US government has been working with financiers. US government debt has skyrocketed while the Treasury's coffers are running dry. Where has the money gone? Primarily into the US stock market, not just because the US economy is strong, but because American companies appear to be, honestly, incredibly profitable. After the pandemic, with so many people working from home, US companies grew even wealthier. This happened because of massive government subsidies. In 2020, when the Federal Reserve pumped money into the market by expanding its balance sheet, US companies borrowed enormous sums at near-zero interest rates. They used this money to buy back their own shares, which drove up stock prices and, even collaborated to inflate financial reports. Interestingly, the money injected by the government ultimately flowed right back to the government. This gave US companies some pretty impressive business figures which attracted global capital into the US stock market. When these US companies had money, they used it to repay the government. So, the government received funds while also helping American capitalists attract international capital, which in turn, they used to buy cheap assets and resources all around the world. Capitalists like Warren Buffett are, honestly, the biggest beneficiaries. They sell stocks at high prices, accumulate vast amounts of cash, deposit it into US government bonds for high interest, and at the same time, scoop up distressed assets in Japan, Asia, and Europe. So, if you solely relied on economic theory, and, hastily sold stocks when interest rates rose, you actually missed last year's wild surge in the US stock market. Looking forward, it's important to remember that predicting the market is never an exact science. There are always variables, and honestly, the future can surprise even the most seasoned investors. Staying informed, flexible, and open to new information is key as you navigate whatever comes next. At this point, true capitalists like Warren Buffett have sold all their shares at high prices. So, who holds US stocks now? Well, it's global capital. So, the first phase of the plan is complete. The Fed raised interest rates, drew money globally, and bought assets at low prices. Ordinarily, the next step would be to cut interest rates, which, allows money to flow back from the United States to Asia and Europe, causing all those accumulated assets to surge in value. However, the United States president has changed, meaning the second phase might actually require renegotiation. The US Treasury is running out of funds, and the government might face a shutdown in the coming months. What will they do? The US government will likely need to engineer a recession that crashes the US stock market, forcing money out of stocks and into US government bonds. At that point, money from around the world would flow from the stock market into US bonds, and basically, into the hands of the US government. But what's happening? According to recent reports from US banks, money isn't flowing into US bonds, it's actually going to Europe and the UK. The dollar index is sharply declining this year, which means the dollar is depreciating against the euro and Japanese yen. Why is that? Well, it's because people are selling dollars to buy euros and Japanese yen. This means the current US administration is trying to create a recession and a stock market collapse to divert money into US bonds. They are constantly emphasizing that US bond yields are at their highest, implying that if you don't buy now, you won't get such high yields later. US capitalists also want a recession and a US stock market collapse. But, the key difference is, they don't want money flowing into US government bonds. Because once the US government solves its funding problems, it gains more control, and US capitalists lose influence. From a self-interest perspective, if the stock market collapses, capitalists can manipulate the market, pushing stock prices from highs to rock bottom. Then, they'll pressure the Fed to expand its balance sheet and inject money into the economy. At that point, they can borrow newly printed money at near zero interest and buy back the very shares they sold at high prices earlier, maintaining control over the US stock market. Crucially, when money flows out of the stock market, US capitalists will redirect it to Europe or other nations where they previously bought assets cheaply, regaining control over those undervalued assets. So, for both the United States government and United States capitalists, a stock market collapse is actually beneficial. The difference is the government wants to attract capital into bonds, while capitalists want to direct money into assets in Europe, Japan, and, other regions. Why is this the case? Many only look at United States capitalists and forget that they originally came from Europe. Before the United States became the world's leading power, Britain and Europe were dominant. A class of wealthy financiers accumulated enormous wealth in Europe. As the United States rose to superpower status, they gradually shifted and established roots in the United States. This is why United States capitalists can easily manipulate Europe. They never truly left, just moved their operations from Europe to the United States. Why is this the case? Many only look at United States capitalists and forget that they originally came from Europe. Before the United States became the world's leading power, Britain and Europe were dominant. A class of wealthy financiers accumulated enormous wealth in Europe. As the United States rose to superpower status, they gradually shifted and established roots in the United States. This is why United States capitalists can easily manipulate Europe. They never truly left, just moved their operations from Europe to the United States. For capitalists, the concept of nation-state doesn't exist. Only maximizing profit matters. These European financial conglomerates parasitizing the United States supported the previous U.S. administration due to its globalization policies. The U.S. printed money and spent it globally, allowing other nations to acquire dollars, boosting their economies, and increasing the value of assets held by capitalists in those countries. However, the current administration pursues isolationism, creating global conflicts and imposing tariffs to force other nations to move factories, talent, and technology to the United States. This means that while the U.S. was previously drained by capitalists, the current administration wants to push back against the control of European financial groups. So why isn't Warren Buffett investing more in European assets like other financial conglomerates, and instead increasing his investments in the Japanese yen and Japanese stocks? Because Buffett is a purely American capitalist, while Europe has long been divided among European financiers, where Buffett's influence holds little weight. Furthermore, he cannot buy gold, as gold is a dollar alternative held by governments worldwide. Pouring money into gold would effectively devalue the dollar. Japan is a different story. Many folks previously borrowed money in Japan to invest in the United States, but once the US economy collapses, money will flow back to Japan. Buffett realized this early on and took a proactive step by heavily investing in Japan. When assets in Japan were sold off cheaply, he even borrowed money in Japan to buy them, becoming one of Japan's top 5 largest investors. The key takeaway is that when investing, we must seek high-probability opportunities and understand where the major money flows are heading. Whether it's capitalists or governments, they both benefit from a U.S. stock market collapse. However, the financial funds of Buffett and European financial conglomerates haven't yet poured money into the U.S. stock market to buy the dip, nor are they buying long-term U.S. bonds. Instead, they're allocating funds to assets in Europe and Japan. So why did the U.S. stock market surge this time? Just before the rally, there was a derivatives contract rebalancing, so large trading volume was normal, but not particularly indicative. Crucially, on the day of the rally, actual trading volume wasn't high. This suggests that while some bought aggressively regardless of price, the number of truly engaged investors wasn't significant. Morgan Stanley surveyed and found that individual investors poured over $12 billion into U.S. stocks last week. Additionally, countless Chinese individual investors are buying U.S. stock index ETFs, such as the S&P 500 ETF from Chi Securities, to the point where its closing price hit the daily limit and trading was suspended. So, why are small retail investors rushing into U.S. stocks? Well, typically, when there's a 10% drop in U.S. stocks, it often leads to a short-term rebound. But, for investors like us, if the big money hasn't actually entered the market, and it's only small retail investors jumping in, the probability of losses stays really high, no matter if you're buying or shorting. Plus, profits are going to be limited because the margin for recovery is just so small. If you don't make enough money and, you fail to exit in time after that rebound ends, you'll end up getting stuck with high-priced assets when the market takes another dive. Shorting, well, that's also pretty risky because you might enter too early. The US economy is honestly in a bit of a tug-of-war right now. You just can't pinpoint exactly when the market is actually going to collapse. If you short too early, like say right now, even a single rebound can force you to cut your losses, or worse, you could face a margin call if you're using leverage. Therefore, shorting is much harder than buying. Only when we are really certain that the United States stock market has entered a true bear market and could decline for a full year, should we even consider this strategy. But even then, I only say consider because we can still choose to invest in other assets like gold. Our ultimate goal is to wait for the Fed to expand its balance sheet and print money again. Before that, if the United States stock market collapses, this will be the biggest buy the dip opportunity of our lives. I don't have a crystal ball or superpowers to know the exact date of a collapse. If someone claims to know the precise day, I wouldn't believe them. But as investors and entrepreneurs, we don't need to predict specific timing. What's important is to bet on high probability scenarios. If this scenario plays out, we must be among the winners. If it doesn't, we shouldn't incur significant losses. At most, we just won't make a lot of money. In principle, Warren Buffett is a major investor, and we are small retail investors. Our strategies might differ, but our investment mindset is fundamentally the